Hello and welcome to India Tonight with me, Ankur Mishra. Let's get started with an important report which has been released by Reserve Bank of India. Reserve Bank of India has released its latest financial stability report, according to which the domestic financial system remains resilient, underpinned by strong balance sheets of banks and NBFCs. The central bank has projected banks' gross NPAs to slightly edge higher to about 1.9% by March 2028 from 1.8% in March this year. In fact, there is also a possibility of the gross NPAs crossing 4% mark if there is a macroeconomic stress condition at the highest order. To decode these numbers in the projection, I have been joined by my colleague Anurag Joshi. Anurag Joshi, take it away.
The Reserve Bank of India's financial stability report says that the macro stress test results show resilience of lenders to macro shocks. All banks would meet the minimum common equity tier 1 requirement of 5.5% under all stress scenarios. The financial stability report says the CET1 ratio of 46 banks may decline to 13.9% in March 2028 from 15.2% in 2026 in the baseline scenario, whereas the CET1 ratio may decrease to 11.6% and 11.4% under adverse scenario 1 and 2 stress scenarios respectively. The Reserve Bank of India said the gross NPA ratio may rise from 1.8% in March 2026 to 1.9% in March 2028 under the baseline scenario, while the gross NPAs may rise to 3.8% and 4.1% under adverse scenarios 1 and 2 respectively under the stress scenarios according to the Reserve Bank. The RBI said that India's financial sector continues to be resilient amid a challenging global environment, and India's sound macro fundamental provide ample buffer to deal with the external shocks. Healthy financial system in the country has helped the economy withstand spillovers from the West Asia crisis, and the balance sheet of lenders is robust with adequate capital and liquidity buffers. The lenders' robust balance sheet also limits the risk of financial shocks limited spilling over to the real economy. The asset quality of shadow lenders shows signs of improvement. The NBFC sector's slippage ratio moderated from earlier peaks, while the global financial stability risk remains elevated. The macro stress test result indicate banking system is well positioned to absorb potential shocks, while the capital ratio is projected to remain comfortably above the regulatory threshold even under hypothetical adverse scenarios.
All right, Anurag Joshi, thank you so much for detailing the FSR report which has been released by Reserve Bank of India. And to discuss this in detail, I have with me Raman Agarwal, CEO of Finance Industry Development Council, or FIDC, and also I have been joined by Madan Sabnavis, Chief Economist, Bank of Baroda. Welcome, gentlemen. First, I want to come to you, Mr. Sabnavis. You would have seen FSR. Now, there are, of course, baseline scenario and severe stress scenario. Under severe stress scenario, banking GNPAs likely to cross 4% mark. I want to understand from you, do you think the system is adequately pricing in the geopolitical tension?
No, absolutely. Actually, when you're talking of the stress situation or the scenarios which have been drawn up by RBI, they've actually been starting off at a baseline of saying that a GDP growth is 6.6% for this year and inflation at 5.1%. Now, in case things do turn adverse and we see GDP growth slowing down and inflation going up substantially, then of course there is going to be a case of stress for the banking system in terms of NPA ratios going up. Now, this is a very, very unlikely scenario because the way in which things have evolved in the last couple of years, we have seen that the banking system has seen a number of shocks coming from the external sector, starting with the Ukraine war, the Hamas-Israel conflict, and subsequently we have also seen the current situation of the Iran-US war. And we have seen that the overall Indian economic situation remains to be fairly resilient. That's what the RBI has also used this particular term. And we're still talking of growth being in this particular region and inflation largely within the MPC's band. So I think what we're talking of, the severe stress scenario, is more of a kind of a hypothetical situation which one has to consider. But in case things go horribly bad in the next year or so, then we're talking of your GNPA rising up to 4%. Now, even if you look at this kind of a situation, is 4% a worrisome number? I would tend to think not, because we'll again have to see from where exactly are these NPAs going to come from. And if you look at the way in which Indian manufacturing, Indian services have been faring, I don't think that could be a problem area. Something not really related to the global economic environment, that's just agriculture, because agriculture has high NPA of around 5.1% for 25-26. This could be a problem area if there's a severe drought and things go bad this year and also next year. So these are hypothetical situations and something which banks have to be cognizant of, so that you're able to accordingly monitor your overall quality of credit to ensure that we don't really reach this situation. But even so, I think if you look at the RBI's commentary and the other forecasts which are made, it looks like that India's banking system would remain resilient even in case of this adverse situation turning out to be true.
Definitely. And I also have with me Raman Agarwal now. Mr. Agarwal, welcome once again. I want to understand from you particularly about NBFCs, a sector which you represent. In adverse case scenario, again, 15 NBFCs are likely to fall in the gray area, if I can use that term. But how do you see the health of overall NBFCs? In the baseline scenario, of course, the things look pretty okay as of now.
Thank you, Ankur, for having me. See, first of all, we need to understand things in perspective. While, yes, we may pick up the figure that 15 NBFCs may suffer if in case of the stress scenario, but 15 out of how many? We are talking of 15 out of 9,500. So I think if you look that way perspective, that figure is minuscule, I mean, perhaps negligible, I would say. So overall, as the report itself says, the NBFC sector is in very good health, has shown sound resilience, is well capitalized, and the asset quality has shown an improvement.
Definitely. But one area, Mr. Agarwal, which has been highlighted in the report also, the gold-backed lending has actually expanded rapidly. And there are lenders actually becoming overly dependent on gold loans. How do you assess this report?
No, see, I think let's look at from the perspective of the overall prevailing circumstances. So we are talking of this in the last financial year, and let's not forget we saw a lot of ups and downs and turmoils. We had a situation where we had Operation Sindoor carried out, and then we had the Ukraine war and signs of stress in the West Asia. All that thing built up. What happens is in such cases people tend to play safe, and then gold loans is something which is perhaps the easiest form of getting a loan from any institution, because that's the safest way to borrow money, and for a lender perspective, that's perhaps one of the safest mode of lending. So I think it's more driven by the circumstances prevailing rather than, as you put it, that suddenly lenders having a special taste for gold loans. It's not that. It's because of the prevailing circumstances, the borrowers thought it fit. That became the flavor of the day. And with the increasing gold prices, there was all the more better.
And we'll await the latest numbers after there has been fluctuations and volatility in the gold prices. But Mr. Sabnavis, RBI also says and clearly that India's financial system remains resilient despite elevated global uncertainty. What gives you the most confidence today, the banking system, macro fundamentals, or the policy credibility, or a combination of everything?
No, actually, as you said rightly, I think it's a combination of everything. See, if you look at the banking sector as such, I think what we look out to see is what is the capital adequacy ratio, number one. to what are the NPA ratios? What is the slippage ratio? Now, here, if you see, there's been a consistently downward movement in general, if you look at the last 5 years. So that gives you confidence that the banks are operating very well. Now, second, if you look in terms of the overall economic scenario and you look at how the Indian economy is performing, I think it's been performing relatively better than any of its peers across the world. And we have seen that the GDP growth has been, which is probably the best indicator for comparison purposes. This is something which has been fairly steady in this region of around 6.5–7%. In fact, even this particular year, I have a feeling that while RBI is talking of 6.6%, we may finally end up with a number closer to 7% in case the piece actually stabilizes. And more importantly, I think when you're talking of what the regulator has been doing, I think that's very important. Because every time they smell some kind of a possible problem, there has been regulatory intervention. And that is something which makes sure that if we are going 4 steps ahead, there is a case of banks being asked to be a bit more cautious while lending. So we'll remember those capital adequacy norms, those capital norms which were increased for, say, NBFCs and for credit cards and other personal loans, the unsecured part. I think those were things which are very, very proactive. So I think proactive regulation, stable economic growth, and banks on themselves being more cognizant of prudence, despite the fact that they are the main object of a bank, of course, is to bring about shareholder value, so they are profitable, good NIMs which are being registered, bringing about good growth in credit dispersed across all the segments. So I think this is a kind of a happy situation to be in. So it's a combination of what banks are doing as well as what the regulator is doing.
Definitely, and the regulator has recently taken steps on the liquidity front as well. And I want to understand from you, Mr. Agarwal, how is the situation, because this report also talks about the measures. Overall, do you think liquidity situation has improved?
Well, yes, see, as has been said, by the co-panelist, that some of the proactive measures taken by RBI in this regard, especially in case of, even NBFCs for upper layer and middle layer, with the LCR framework coming in, I think the liquidity situation remains that way to a comfortable level. Although there may be challenges in terms of availability when it comes to the prevailing circumstances. However, broadly, if you look at the financials, I think there is perhaps no reason for any concern in terms of the liquidity situation for the sector as a whole. And I think I would agree with that statement that it also is a direct manifestation of some of the proactive measures taken by RBI in this regard.
Right. Overall, Mr. Sabnavis, I want to understand the household debts situation also, which was on rise and driven by largely the unsecured credit and retail borrowing. At what point does the leverage becomes a macroeconomic concern?
Yeah, it becomes a concern in case we see the NPA ratio rises. Because finally, at the end of the day, we should say that even if I'm taking consumption loans, I'm borrowing for the sake of consumption, not for the creation of an asset like a house or maybe a vehicle. There's nothing wrong in it, because if you look at the entire American economic growth story, a large part of it was driven by consumption, which was supported by leverage. So to my mind, I think there's nothing wrong. But the important part is, are we getting the credit appraisal right? Is it a case of me lending a lot just for the sake of getting hold of target, meeting a target and showing that growth of 20–25% or whatever a bank decides? Or is it a case of doing it in a judicious manner? So the best way to find out is to see as to how banks are performing in terms of the NPA ratios. And normally this NPA ratio gets stressed when there is an economic slowdown. So if there's a GDP growth slowdown, which means incomes are not rising, probably jobs are not being created, people are going to have a problem in terms of servicing their debt, I think that is a red flag which is raised. So as of today, if you look at it, I think it's a fairly comfortable position. I think the number is around 1% for unsecured loans, which definitely is well below the average for even personal loans or even for your slippage ratio. So to my mind, that's not an issue. But I think what is important is that whenever the RBI did sense that there was something amiss possibly going on in this particular sector, there was regulation which actually tells banks that, look, you need to tighten your shoelaces, make sure that you're more judicious when you're lending. And I think that's how the thing will be operating also in future.
Right. And Mr. Sabnavis, also Reserve Bank of India is talking about AI-driven cyber risk. Should cyber resilience now be viewed as financial stability issue rather than merely operational risk?
No, absolutely. I think this is something where we know very little about as to what is the kind of danger, what is the kind of risk which is posed to the system. And this is something which needs to be emphasized all through by the regulator and also followed up by banks. And I'm quite sure there is going to be, we are expecting some kind of a notification coming from the RBI in case of a discussion paper about how exactly do we tackle risks when it comes to AI from the point of view of the banking system, as to how far should we be adapting AI, and what are the kind of safety measures which should be there. Because one of the major problems when you get in technology is the case of fraud, especially at a customer level, because the customers may not understand it. We as bankers may know a little more, but definitely the customers need to be more educated. They have to be, it has to be ensured that they actually don't fall victims to any kind of such fraud, which is possible once you depend more on AI. Even in things like, say, for example, credit appraisal, it has to be the human intervention which is most important. AI should be an enabler, a supporter, something which helps you to take decisions, but should not be the deciding factor when it comes to taking credit decisions. That's what I think should be the general direction when we're talking of AI and accompanying risk.
Definitely, Mr. Sabnavis as well as Mr. Agarwal, thank you so much for taking out time and joining at this hour.